The MACD indicator is a powerful tool that many traders think they understand, but often miss its nuances. It's not just about the basics. The real edge comes from mastering its details. In this video, I'll break down the MACD indicator step by step, focusing on practical, actionable insights. We'll cover its core components: the MACD line, the signal line, the histogram, and how to interpret them. Stick around to learn about divergence, a game changer for identifying major reversals. Let's dive into MACD basics. Understanding the MACD is crucial before making trades. MACD stands for Moving Average Convergence Divergence. It tracks the relationship between two moving averages of an asset's price. The MACD uses exponential moving averages, EMAs, for quicker responsiveness. The standard EMAs are the 12-period and 26-period. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. When the MACD line is above the zero line, it suggests bullish momentum. When below, it suggests bearish momentum. The MACD line oscillates above and below the zero line, indicating trend strength and direction. Understanding this foundation is crucial for interpreting the MACD. Now let's introduce the next key piece, the signal line. The signal line is a 9-period EMA of the MACD line. It smooths out the MACD line, helping to filter out noise. The signal line generates trading signals when the MACD line crosses it. A bullish crossover occurs when the MACD line crosses above the signal line. A bearish crossover occurs when the MACD line crosses below the signal line. The signal line provides a reference point for the MACD line. The interaction between the MACD line and the signal line is crucial for many MACD strategies. The signal line lags behind the MACD line, creating crossover signals. This lag is intentional and provides confirmation. The signal line helps you navigate the market's twists and turns. Now let's look at the third visual component, the histogram. The MACD histogram represents the difference between the MACD line and the signal line. This difference is plotted as bars on the histogram, which can be either positive or negative. The histogram provides a visual representation of the momentum in the market, making it easier for traders to identify potential buy or sell signals. Positive bars indicate the MACD line is above the signal line, showing bullish momentum. When these bars grow taller, it suggests that the bullish momentum is strengthening, which could be a signal to enter a long position. Traders often look for these growing positive bars as a confirmation of an upward trend. Negative bars indicate the MACD line is below the signal line, showing bearish momentum. As these bars grow taller in the negative region, it suggests that the bearish momentum is increasing, which could be a signal to enter a short position. This is particularly useful for traders looking to capitalize on downward trends. The height of the bars indicates the strength of the momentum. Taller bars, whether positive or negative, signify stronger momentum. This can help traders gauge the intensity of the current trend and make more informed decisions about their trades. Shortening bars suggest waning momentum, even if still positive or negative. This can be an early warning sign that the current trend is losing steam, and traders might want to prepare for a potential reversal or a period of consolidation. The histogram crossing the zero line confirms MACD signal line crossovers. This crossover is a significant event, as it often marks a shift in market sentiment. When the histogram moves from positive to negative, it indicates a bearish crossover, and vice versa for a bullish crossover. The histogram provides a quick visual cue about changes in momentum. By observing the fluctuations in the histogram bars, traders can quickly assess whether the market is gaining or losing momentum, allowing them to make timely trading decisions. It helps you see the direction and strength of the momentum. This is crucial for identifying the prevailing trend and understanding the market dynamics. Whether the bars are growing or shrinking, their direction and size offer valuable insights into the market's behavior. The MACD histogram is a powerful visual tool. It simplifies the complex relationship between the MACD line and the signal line, making it easier for traders to interpret market movements and make informed decisions. It graphically illustrates the distance between the MACD line and its signal line. This distance is crucial for understanding the strength and direction of the market's momentum. The greater the distance, the stronger the momentum, whether bullish or bearish. When the histogram is expanding, momentum is increasing. This expansion can be a signal to stay in a trade or even add to a position, as it indicates that the current trend is gaining strength. When it's contracting towards the zero line, momentum is fading. This contraction can be a signal to exit a trade or reduce a position, as it suggests that the current trend is losing its strength and a reversal or consolidation might be imminent. Keep an eye on it. It adds depth to your MACD analysis. By incorporating the histogram into your trading strategy, you can gain a more comprehensive understanding of market momentum and make more informed trading decisions. Crossovers are key for MACD traders. The moving average convergence divergence, or MACD, is a popular tool among traders for identifying potential buy and sell signals. It's based on the relationship between two moving averages of a security's price. A bullish crossover occurs when the MACD line crosses above the signal line. This is often seen as a sign that the stock's momentum is shifting upwards, indicating a potential buying opportunity. Traders look for this crossover as a signal to enter a long position. This suggests upward momentum and a potential buy signal. However, it's important to remember that no indicator is foolproof. The bullish crossover should be confirmed with other technical indicators or market analysis to ensure its reliability. A bearish crossover occurs when the MACD line crosses below the signal line. This indicates that the stock's momentum is turning downward, suggesting a potential sell signal. Traders might use this as a cue to exit long positions or enter short positions. This suggests downward momentum and a potential sell signal. Just like with bullish crossovers, bearish crossovers should also be confirmed with additional analysis to avoid false signals. The zero-line crossover involves the MACD line crossing the central zero line. This is another significant signal for traders, indicating a shift in the overall trend of the stock. When the MACD line crosses above the zero line, it indicates a shift to bullish momentum. This can be a strong signal that the stock is entering an upward trend, and traders might consider this as a good time to buy. When it crosses below, it indicates a shift to bearish momentum. This suggests that the stock might be entering a downward trend, and traders might consider selling or shorting the stock. Crossovers are lagging indicators based on past price data. This means they reflect price movements that have already occurred, which can sometimes result in delayed signals. Therefore, relying solely on MACD crossovers can be risky. Always look for confirmation from other indicators or price action. Combining MACD crossovers with other technical analysis tools, such as RSI or moving averages, can provide a more comprehensive view of the market. Combining signals increases your odds. By using multiple indicators, you can filter out false signals and increase the likelihood of making successful trades. MACD crossovers are valuable but not infallible. They should be used as part of a broader trading strategy rather than in isolation. Treat them as alerts and confirm with other tools before acting. This cautious approach can help you avoid potential pitfalls and make more informed trading decisions. Next, we'll talk about divergence, a potential leading signal. Divergence can provide early warnings of potential trend reversals, offering traders a valuable tool for anticipating market movements. Divergence is a powerful aspect of the MACD. It's like having a crystal ball that gives you a glimpse into potential future market movements. By understanding and identifying divergence, traders can gain an edge in predicting trend reversals before they happen. It can act as a leading signal for potential trend reversals. This means that while most indicators are lagging and show you what has already happened, divergence can hint at what might happen next. Bullish divergence occurs when the price makes lower lows, but the MACD makes higher lows. This is a sign that the downward momentum is weakening, and buyers might be stepping in. This suggests weakening selling momentum and a potential reversal to the upside. Traders often look for this signal to enter long positions, anticipating a rise in price. Bearish divergence occurs when the price makes higher highs, but the MACD makes lower highs. This indicates that the upward momentum is losing steam and sellers might be gaining control. This suggests weakening buying momentum and a potential reversal to the downside. Traders might use this signal to enter short positions, expecting the price to drop. Divergence gives you a heads up about potential trend changes. It's like a warning sign that the current trend might be running out of steam. Spotting divergence requires careful observation of significant peaks and troughs. It's not always obvious and can be easy to miss if you're not paying close attention. Divergence can sometimes give false signals, so wait for confirmation. This means that while divergence can alert you to a potential change, it's important to look for additional signs before making a move. Confirmation could be a MACD crossover, a break of a key trend line, or a candlestick reversal pattern. These additional signals help validate the divergence and increase the likelihood of a successful trade. Divergence tells you to pay attention, confirmation tells you to act. Together, they form a powerful combination that can significantly improve your trading decisions. Mastering divergence adds a serious tool to your trading arsenal. It's not just about spotting the signals, but understanding their implications and acting accordingly. With practice, you can turn this knowledge into profitable trading strategies. We've covered the MACD line, signal line, histogram, and divergence. You now have a solid toolkit to understand and apply the MACD indicator. If you found this helpful, smash that like button and subscribe for more content. Drop your questions or suggestions in the comments below. Remember, mastering any trading tool takes practice and patience. The MACD helps you read the market's rhythm and identify opportunities. Keep learning, backtesting, and practicing. The goal is to consistently put the odds in your favor. You absolutely got this. See you in the next video.